Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 61 titled Realized versus Unrealized Capital Gains. We're going to use a real-life example with Guidewire Software, Inc., which trades on the New York Stock Exchange under the ticker symbol GWRE. Now, when we do our option selling, in this case, covered call writing calculations, there are several different layers of these calculations that we must be aware of. And we're going to relate these all to realized versus unrealized returns. First, we have our initial returns, which basically tells us how the trade was initially structured. Then we have our final returns at the end of the contract month, which again can be realized or unrealized. We have our stock calculations. Remember, we bought the stock, so we're long the stock when we do covered call writing, and we're short the option, so we have our long stock and our short call calculations. So all of these different types of calculations must be fully understood and not commingled so that we can make the best trading decisions at every point in time. Ralph was good enough to send me a trade that he executed with Guidewire, GWRE, on July 22nd, 2019. He purchased Guidewire at 102.22 and then immediately sold the out-of-the-money 105 call option, which expired on August 16th, 2019. So it was about a 3-week plus trade, let's call it a month. And the premium that he received was $1.13 per share. Now, if we feed this information into the multiple tab of the Ellman calculator, we would see that the actual return on the option, or ROE, was 1.1%. That's the premium of $1.13 divided by the price of the stock, 102.22, 1.1%. Now, there is a lot of upside potential here if Guidewire moves from 102.22 up to the 105 strike. And that's represented by an additional 2.7%. So overall, there's an opportunity for 3.8% 1-month return. Now, the break even is 101.09, which is the price that was paid, 102.22, minus the 113 premium. Now, there's no downside protection of the option profit because we sold it out of the money strike. Downside protection would only apply if we used an in-the-money strike, where we use the intrinsic value to protect the time value. There's always a break even, and that again is 101.09. Now, let's see what the final results would be if the price of the stock moved higher than the 105 out of the money strike. Well, then we will have maximized our return because we had the initial 1.1% plus the upside of 2.7. We would end up with a 3.8% 1-month return. That's the best case scenario. Now, at that point in time, either the shares will be sold or they won't be sold if we buy back and roll the option. So if the shares are sold, that 3.8% will then be realized. Otherwise, it will be an unrealized profit up to the strike price, and the option premium will be realized. So sometimes you have to break it down if both legs are not closed at expiration. Now, let's say hypothetically that the price of the stock does move higher, but not all the way to the 105 strike. Let's say it moves up to $104. Well, the option will not be exercised, right, because the strike is still out of the money. So we have a realized profit on the option side of $113 per contract. Once that expires worthless, we have pocketed the $113 per contract. But now we have an unrealized profit on the stock side of $178 for the 100 shares per contract. That's 104 current market value in this hypothetical, minus the price paid, 102.22, It's $1.78 times 100, $178 per contract. Now, if we then sell those shares, then the stock profit would also be realized. Now, what if the price of the stock moves lower, below the purchase price of 102.22? Well, the spreadsheet shows that the break even is 101.09. So the overall profit or loss will depend on that threshold. Is it higher than 101.09 or is it lower? If it's higher, there's a small profit. If it's lower, there's small to great loss. So, it depends on the price. Of course, this doesn't take into account our exit strategy arsenal. And before we enter any trade at all, we must master the position management skill, the third of the 3 required skills, with the other 2 are stock selection and option selection. So if the price does decline, that profit or loss will be realized or unrealized, depending on whether or not we sell the shares at contract expiration. So you can see there are several factors we have to understand. We can't get them confused now. We have to understand them. So to summarize, covered call writing calculations have several components to them. We have our initial calculations and we have our final calculations. We have realized versus unrealized capital gains or capital losses. Now, the initial trade setup must incorporate what our initial time value return goal range is. In my case, I shoot for 2% to 4% per month. This particular Guidewire trade would fall a little bit below what I'm looking for. Now, my mom's portfolio, I lower my my guidelines to 1% to 2%, so it would make sense in my mom's portfolio, more conservative, when her goals are a little bit lower than mine. So once we enter the trade, then of course we go right into position management mode. We enter our buy to close limit orders, 20%, 10% guidelines, and we manage from there. Of course, trade management is something that I emphasize in all of my books and DVDs, articles, videos, everything. You see that that's a very, very significant part of the methodology. So once again, there are a myriad of free resources on our website, www.thebluecollarinvestor.com, including the basic Ellman calculator, which you listen to me talk about in this podcast. And there's also a put calculator, many other free resources. Check out our articles on the blog, and as well as other training videos. We have our Beginner's Corner tutorial for those of you new to option selling. Just check the web pages on the top right side. Click on the Beginner's Corner link. Start with covered call writing. Eventually, you can move to cash secured puts. Just put in your email address, and you have access to those videos. As far as the bluecollarinvestor.com store, we have all of my published books plus some ebooks. Some of them are in soft cover. All of them are in soft cover. Some are in hardcover. We have PDF versions, calculators, spreadsheets, trade planners, online DVD programs. You name it, we have it. All of these products will help get you to an elite level of covered call writing and put selling. I want to get you from where you are to where I am now after more than 2 decades of trading stock options. I want to thank you, ladies and gentlemen, for listening to this BCI podcast, number 61, Realized versus Unrealized Capital Gains. Hope you enjoyed this podcast. Most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.